back to Money Talks. I'm Mia Lee, escort, stripper, CPA, and recovered banker. So today is part one of a two-part episode I'm doing on mutual funds and ETFs. What are mutual funds? A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, and other securities. Every mutual fund share represents a percentage of the holdings of the fund that's managed by a professional fund manager who decides how to allocate the pooled investments. The value of a mutual fund shares is determined at the end of each trading day based on the total value of the fund's holdings, known as NAV, or net asset value. I personally stay away from mutual funds, partly because I have friends who work in the industry who I think are really overpaid for the value they add. Sorry guys. There are good mutual funds out there, so this is a really sweeping generalization, but in general, fees keep me away from mutual funds since a lot of them have very opaque fee structures, and most of these guys don't really outperform the markets. No thanks. You could end up paying some pretty substantial fees for mutual funds, and this is a topic that I really wanted to talk about because those of us who are starting to accumulate wealth in our careers are kind of peppered by inquiries from our banks and their asset managers trying to sell us mutual funds. So I want to clue you into how the fees work for mutual funds. You could end up paying front-end fees, back-end fees if you sell early, and management fees, as well as 12B1 fees paid for the administration. What are all these fees? Front-end loaded fees, or A shares, are the worst. You basically pay 5%, which is the commission paid to the advisor who puts your investment with the mutual fund. If you bought 100,000 A shares, you're starting with a value of 95,000 off the bat before you've made a single dollar in investment returns and gotten a single dividend, gotten a dollar of capital appreciation. You're already out that commission. Back-end loaded fees are also bad if you don't buy and hold. So if you sell your mutual fund shares within the first year, they typically charge you a little over 5% because it's disruptive to the mutual fund manager's investment strategy and they have to reallocate the portfolio every time someone pulls out of the fund. Essentially, this 5% fee for early selling is a penalty, and this fee does walk down 1% every year that you hold the funds. If you sell your mutual fund shares after 5 years, there probably isn't a back-end fee anymore, but you got to leave your money in for 5 years and you can't just buy or sell in and out as flexibly as you could with an ETF. Here's why I love ETFs more than mutual funds. An ETF is a type of investment fund that also pools money from many investors and invests in diversified baskets of assets. ETF fees are a lot more straightforward. They primarily incur costs through their expense ratio, which includes management and operational fees. The expense ratio is deducted from the ETF's assets and reflected in the daily price or the NAV of the ETF. You don't have this opaque fee structure. And investors don't really pay these fees directly because the shares that you buy in an ETF are already reflective of these fees, and ETFs disclose their expense ratio. So you already know what you're paying. Unlike mutual funds, ETFs don't have sales loads, meaning the front end fees, or marketing fees because they're not marketing. While ETFs and mutual funds have a lot of similarities in that they pool money from different investors and they give you asset exposure that is diversified, fees are really what make the difference. Another thing about mutual funds is that they tend to have investment minimums and ETFs typically don't. So the investment minimum in an ETF is what one share of that ETF costs. It's typically under $500. Some of them are even under $100, so that's very accessible to most people. Whereas mutual funds tend to have higher investment minimums. ETFs are not only more flexible, they're also cheaper. Great deal on a relative basis, in my opinion. And you have a lot more flexibility with ETFs, so you don't get charged for pulling out your money early, or whatever early means, based on the investment terms. You can buy and sell ETF shares just like stocks, and you can even short them. Mutual funds, on the other hand, trade once a day at market close. From a tax efficiency perspective, ETFs are often more tax efficient than mutual funds because generally ETF holders don't have to pay capital gains tax until they sell the shares of the ETF. Mutual funds, however, reallocate their holdings periodically, which will result in taxes due, even if the mutual fund holder is still holding the shares and hasn't received any cash. So for instance, if you put $10,000 into a mutual fund and the mutual fund manager then buys and sells some shares and takes dividends and reinvests them, but you didn't actually receive any cash, you might still have to pay taxes on those sales if there were gains and if there were dividends paid, even though they were reinvested in the fund. So you could theoretically have to pay taxes even though you've received no actual cash to pay these taxes. For retirement accounts, I do want to note that retirement accounts like 401ks or IRAs do have a relative tax advantage because you don't owe taxes on mutual fund holdings that incur gains and losses within your retirement accounts, such as 401ks or IRAs. Another thing that I want to point out is that because of the low charges, meaning the commissions that investment advisors incur and earn to place your money with a mutual fund, you could have a potential conflict of interest. That person that calls you from your bank that says, I think you should invest in ABC mutual fund, they're incentivized to put your money there because they get a fee off the top, whether or not this mutual fund is actually good for you and makes you money. There's a potential conflict of interest there that doesn't exist with ETFs. I'm Mia Lee. You can take the girl off Wall Street, but you can't take the banker out of the whore. Please leave me your questions, comments, and suggestions for future content.